Hello and welcome to another edition of The Buck Stops Here. I'm Catherine Murray. The goal of my program is to provide informed, fact-based discussions about the matters that impact Canadian businesses, both large and small, the markets, and your money. Speaking of which, we're going to focus entirely on the markets and your money today. I have Ian Verteuil joining us now. He's CIBC's head of portfolio strategy. Ian, great to be with you today. So much to discuss. So thank you so much for joining us.
Nice to be here.
Thank you. It's been an incredibly busy week so far. We're taping on a Wednesday. It airs on a Sunday. But we've got a lot to discuss. We've got the potential implosion of a very large China-based property manager. We've got the Fed announcement today, maybe setting out the stage for tapering. And then, of course, we just had the Canadian elections. So with that said, where do you want to start from a macro perspective? What's most important for investors to know?
Sure. So first of all, I think we need to start from the perspective that equities are expensive. I think that's a going-in position. I think when you start from cheap equities, many of these challenges that invariably develop, many of them unpredictable, one of the big questions is, am I starting from a good position or a bad position? In this particular situation, particularly US equities are quite expensive, 22 times forward-looking earnings, really with a fair amount of optimism built in. So I think that's the backdrop, that's the context. But you're absolutely right. I would say two quite material events and one relatively insignificant one. The insignificant one would be the Canadian election. Not insignificant because I would say only insignificant because the outcome was pretty much what most expected and basically what the status quo was. So I think a relatively minor impact. The China Evergrande situation has been one of these slow-moving train wrecks where it's been rumored for an extended period of time that they would that they would default on payments. And I think that's an issue. There's a bigger narrative on China, but we can discuss that as well. And then the Fed, the question of the tapering, when they scale back buying using QE and buying long-dated bonds. But I would expect even that to be taken in stride. It's just that we start from a relatively expensive period with respect to US equities, and we're starting to see that volatility. And I think Monday was an indication, not of a implosion of equities, but certainly a back 3 months of the year that's going to be really choppy.
Right, and so it's interesting because how you're kind of framing it is basically like if equities weren't as expensive as they are on a valuation perspective, these events may not have roiled the markets the way they did on Monday of this week.
Yeah, I would say so. I think Jeremy Grantham always says who's a wonderful predictor of markets, certainly longer term. He's not the best at calling peaks and troughs, but has a great track record in the long term. His point continues to be, which is one I subscribe to, which is that when you start from valuation levels such as they are, there is less margin of error. So you go back to the old Graham and Dodd's theory. We need margin of error when we're investing. The future is uncertain. Things happen. And if you've got a margin of safety, it ensures that if things surprise you, which quite frankly, you and I know each other a long time. We've been surprised by things on an ongoing basis, quite frankly.
Let me just ask you, as it relates to the Fed, do you think that whatever they say today is priced into the market? I'm kind of feeling like it is, but they can always surprise us, and they can always be wrong, right? One of the biggest risks is that they're going to start pulling back the bond buying program, maybe move forward the dot plots even at a time where I think you believe we're actually seeing peak growth, peak earnings.
Yes, yeah. I think, so your question on whether it's priced in, the answer is yes. But I would also say, China Evergrande defaulting on payments, I don't know, for the last 2 or 3 weeks, we've been discussing that. And just this week, it ended up being more and more of a concern. I think this comes back to the issue of what's your margin of safety, what's your margin of error on some of these things. But I do think the Fed, I think everyone expects the Fed to make a statement, if not at this meeting, at the next one, with respect to the slowing down of bond buying.
Okay.
I also think it's pretty well telegraphed that they're not going to raise short-term rates anytime soon. So I would say, yes, it's largely priced in, I think. But I think the market's telling you that all the good news, earnings rebound, some sort of path to the end of or the control of COVID, I think those things are largely priced in as well.
And we are back with Ian Verteuil, CIBC's head of portfolio strategy. Ian, we were just discussing kind of the big macro factors, and really we're at a point in time, and we've kind of known this, where valuations are high, pretty much across the board. It's difficult to find value, and therefore you really have to employ the right strategy. And part of that dovetails into the fact that you're looking at the economic data. You are seeing inflection points. Walk us through exactly what you're seeing to perhaps make us, I think, a little bit more defensive in our portfolio approach.
Sure. I think in the previous segment, we talked about how expensive equities were, but I think the inflection points are always something to keep in mind. When is something changing? And I think we have three relatively clear signs that things are, that we're at an inflection point. The first thing I would say is that earnings revisions have started to moderate. So we came through the crisis and coming out of the crisis where we very much had a very difficult time knowing how quickly earnings would bounce back. They've bounced back incredibly well. I think corporate Canada, corporate America, I think most corporations in the world have done an excellent job at trying to figure out how to deal with an environment like this. And so I think the one inflection point is certainly that the earnings revisions, which were incredibly positive, have started to slow quite dramatically. The second thing we're absolutely seeing is that the stocks are responding less well to the results that actually come out. In the last couple of quarters, companies that have missed have been roundly published, and those that have surprised on the upside have got, quite frankly, very little benefit, I think, as we move forward. So you're starting to get into those environments that I think really suggest that earnings growth is really starting to moderate. And last, the third point, I mentioned there were three. The third point I would mention is the actual year-over-year growth rate. We peaked in the first and second quarters. Remember, second quarter of this year, we had roughly a doubling of earnings versus the second quarter of last year. That simply reflected the fact the second quarter was quite poor. So as we move forward, we've got three inflection points. Earnings revisions aren't material. The year-over-year earnings growth becomes much more moderate, and stocks are responding less well to earnings surprises. So I think all those suggest that the market has incorporated much of the good news. And as I say, that's to an extent evidenced by valuation.
Do you think, though, or what would the counter to that be, the bullish argument, which might be that given that, it's really taking time to get through this economic recovery, or at least the impact that the fourth wave is having, the Delta variant, that we've got maybe an elongated business cycle that could last longer than people had anticipated? We're going to continue likely to have fiscal stimulus and perhaps even continuation monetary stimulus. Does that not all bode well for maybe we've got peak earnings now, but if we look out 12, 18 months from now, will we not see some growth? Or what is your growth rate expectation?
Yeah, so right now the forecasts are for the earnings growth at the SPX of about 12%. So that's a pretty robust growth as we go forward. And I would also mention, when I talk about valuations, I talk about prices on 12-month further out earnings. So we're not even talking about 22, we're talking about 23, I think, as we move forward. So, but coming back to your key thesis, which is there are a number of things which really support valuations. And I absolutely would agree with you on that we have record low interest rates, and I think the monetary stimulus and the fiscal stimulus is well entrenched. The point I would make on those second two is, first of all, we're talking about the Fed actually scaling back bond buying. So effectively, you're starting to see that the monetary stimulus is beginning to wane. It's not turning negative, but it is beginning to wane. And the second is with respect to fiscal stimulus. Remember, if you spend $1 billion this year and you spend only $800 next year, that actually is a headwind to economic growth. So while I think there will continue to be stimulus, it certainly looks across the board, whether it be Canada, whether it be the US, whether it be globally, of government authorities starting to scale back purchases. I'm not saying they're reducing, they are pulling back, but the reality is if you spend $1 billion one year, you have to spend $1 billion the next year to get more growth. And I think that's what's it. So all of those things make me think that the market's not going to roll over meaningfully, but it's also one that tells you most of that, particularly on forward earnings, are relatively well priced in from my perspective.
Okay, and we'll figure out the right sectors and approach when we come back. We'll take a quick break. And we are back with Ian Verteuil. Ian, you know, it's interesting. We've set out the stage that, you know, really makes investing a little bit more challenging going forward. So I think you really do have to be tactical. I mean, we have to be on this every day, really. But in terms of your view right now from a portfolio strategy, I want to focus in on dividends. I think we've got a lot of viewers and Canadians who love dividends. We've got interest rates that are so low. We've got to be able to make some money off of our money. So talk to us a little bit about how we should approach dividend investing right now. You wrote a detailed report on this.
Sure, I do think, you know, in our previous segments, it made it sound as if I was a harbinger of death. So I don't want you to think that. I still think equities are the best looking house on probably a mediocre street. That's how I would think of it, particularly with bonds where they are. And particularly with exactly as we're speaking about the Fed actually starting to reduce its support for bond buying, you would expect long-term interest rates to start to rise, which means you get your carry on your bonds, but you're probably going to lose a bit on your face value unless you hold them to term. Equities do, in that environment, I think, remain the best game in town. But we do have to remember that really we're probably looking at mid-single-digit returns over the course on an ongoing basis, I think, for the next 12 to 18 months. And you're absolutely right. Dividends have become more and more important. They've always been important to Canadian investors, and I think they're becoming more so. I remind everyone that in the long term, dividends have made up 30 to 40% of the returns from the TSX over time, and 15 to 30% of the returns for the S&P 500. So we forget this in a world where equities are appreciating at 15% a year. The dividends seem like a pittance. And the reason I think dividend investing, and particularly dividend investing in the TSX, looks as attractive as it looks today, is the fact that we have yields on the TSX of 2.5%, which is a running yield. And that's before we see the big banks have their shackles removed as OSFI actually removed some of the limitations coming out of COVID. We have that. We have the big energy companies that have stockpiled a huge amount of cash, particularly during the crisis. So we think there's two of the very large sectors certainly suggest to us the dividends. Not only are the dividend yields attractive today relative to fixed income, but they also look as if the dividends are going to be growing, I would say, materially over the course of the next 12 months.
And when you say dividends are going to grow materially, are you specifically then talking about the financials? It certainly sounds like yes, but also the energy companies?
Yeah, I think the energy companies, and again, we know the pipeline stocks have been very consistent and very clear on their trajectory on actually increasing dividends over time. But we have many of the large Canadian oil companies that really hunkered down. And let's not forget, there was a couple of times last year where it looked like oil, as if oil was cheaper than water. So I think a number of them stockpiled cash. Furthermore, with respect to the energy patch, there's a tremendous resistance to invest heavily in whether it be oil sands, whether it be conventional, simply because there's been such a backlash from global investors on the issue of ESG investing and carbon footprinting within portfolios. So I think we've got that unique situation where at $65, $70 oil, many of our companies make a lot of money, and many of them are quite reluctant to actually invest in the core business in the environment in which they face on an ongoing basis.
And I think there's been a call from some large investors over the past number of years to the energy companies to really return that cash flow to investors. Have you talked to many of the CEOs? Do you think that that's actually going to be what happens? I mean, because energy companies, they're cyclical in nature. You don't normally want cyclical companies paying dividends that then they have to retract.
Yeah. So I think we're going to get sort of a 1-2 punch. I think we're certainly going to get some dividend increases, but I think we're also going to see buybacks as we move forward. And these are buybacks, I think, that are well supported by the business models in the sense that if you are building up excess cash, to your point, do you really want to jack your dividend meaningfully, or do you want to use buybacks, which are really a sliding scale? I've often used the analogy that dividends are like marriage and buybacks are like dating. You are able to change your decisions in the latter. So I think we'll certainly see buybacks as well.
Okay, we'll take a quick break. We'll be right back. Ian, we were just discussing the importance of really looking for dividend stocks in order to achieve the returns that people want over the next couple of years. Talk to us about a few specific names that you can mention that you think are attractive right now.
Sure. Well, certainly I do want to point everyone to the Canadian market. The Canadian market, from a dividend point of view, is the cheapest it has been relative to S&P 500 on a dividend yield basis in the past 30 years, and extreme. So I would say there's a lot of opportunities in the Canadian market. Even broad-based investing in the TSX, the yield's 2.5, it's 1.5 in the US, and I believe we're going to have dividend growth at least as good as what they achieve in the US. With respect to specific sectors and names, call me old-fashioned. I think the financial institutions, the banks particularly, have shown a track record of increasing dividends consistently over time. They haven't increased dividends during COVID for regulatory purposes, but I think it's been absolutely clear they've been able to earn through those. So companies like Royal Bank and TD that have excellent long-term growth trajectories and dividends would be particularly positive. Within financials, I think something like Intact, which has a lower yield, but certainly very good growth in its dividend over time. Beyond that, I think the pipelines carrying very attractive yields, Enbridge and TC Energy, very attractive yields. And the payouts look a touch high. You could certainly argue on that, but it's well covered by cash flow and have certainly committed to continue to increase their dividends over time. So I think those would be the types of ones I think would be particularly good. Within the REITs, there are a few names, a few of the stocks as well. The more defensive ones, obviously, are the ones underlying the Loblaws and Canada Trust and Canadian Tire businesses. So very defensive, well-run REITs as well. So I think that there's a lot of opportunities there. And I remind everyone, these are companies with extremely long track records, good dividend coverage as we move forward. And dividends are extremely attractive from a taxable point of view versus fixed income, and particularly Canadian dividends versus US dividends.
I was wondering a little bit about the REITs. I personally stepped in and bought some REITs, Smart Center, with, I don't know, I think I have probably a 9% yield on it. So, I figured long term, I'm fine. And, I wonder though, Ian, are there any that you would go down or up the risk curve in the REIT sector a little bit more?
Yeah, I'm always a little bit tentative to go down the risk curve. I think we certainly know that there's going to be the reopening is occurring. Vaccine passports are going to accelerate that as people become much more confident to go out and shop. So I think the work from home, Amazon daily delivery to our respective homes, I think all those things will start unwinding. I do think, though, we have to remember that there's a cyclical element for the reopening, but I would also say over time, we've seen more and more of these retailers have problems. So I think retail is one of those ones you have to be very careful of, I would say. And on the office side, I'm going back into the office at some stage, but I think I think those business models have changed. So I'm much more comfortable with some of the stable REITs.
Understood. And just last words of wisdom to viewers today, Ian, as it relates to thinking about the markets and the headlines that come out that seem to pose risk. What do you say when you see these headlines, and what do you think about?
Yeah, so I'm not sure I have the words of wisdom, but I'll give you my perspective anyway. I think the reality is we need to think long term as we invest. It is very easy to get caught up in the news of the day. Is Evergrande gonna blow us up? Are things incredibly good? Is reopening incredibly swift? I think all those things are there, but at the end of the day, I believe you need to look at dividends. We have had a couple of years of outstanding price appreciation. So I think high quality dividend payers, I think, will stand the test of time. I think, and I also think we need to pace ourselves and not be caught up in the next story we heard at the cocktail party while walking on the sidewalk.
That's great. That's great advice. And the word cocktail party, won't that, and isn't it fun? So, Ian, great to see you. I'll leave it there, and we'll speak soon. Thank you.
Thank you.
And thank you so much for watching. I hope you enjoyed all of the information that Ian Verteuil brought to us today in terms of those dividend stocks. Thanks so much for watching. We'll see you next time.